Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video, let us revise that chapter which haunts a lot of students. It's the chapter on variances. Variances you have learned the basic variances in your MA exam. Also, those who have gotten exempted would probably not know. So I'm going to revise the ones that we learned in the MA exam also, just so that we are on the same base to be able to understand the advanced variances. I will try to break these variances down into very simple terms so that you are able to understand. And personally, I never used to remember the formulae. I only understood the concept and I never had to learn the formulae. It just came to me. So I'm going to try to teach you the way I learned it. So I hope that this video helps you to get better in the concepts of variances. Let's get started. So first, I am bringing the variances which we have learned in the MA exam. So the first variance that I'm going to talk about is the sales price variance. So try to think, what this variance exactly tries to measure. So this is about the sales price. Sales price is something which the business is actually, generating sales on. So the more the sales price, the better it is for the business. So basically, what we are comparing over here is what the selling price according to the standards was. So the standard selling price and difference of the standard selling price with our actual selling price. So let's suppose if my standard selling price is $100, and actually I have been able to sell this product in the market as 105, then I'm actually going to have a favorable variance, because the more the sales price, the more money that the business makes and eventually more profits. So over here, basically we are looking at the difference. So the difference will be actual selling price minus the standard selling price, and you multiply this with your actual quantity that you have sold. So with this, you'll be able to find out how much extra have you earned in terms of revenue. So you had thought that let's suppose we actually sold 500 units. So we were thinking that we will be selling 500 units at the rate of 100 per dollar, but we actually sold it for 105. So basically the difference, which is 105 minus 100 multiplied by actual quantity, which is 500. So I have earned extra $5 on each unit, and so that means $2,500 is my favorable sales price variance. That means how much ever I had estimated the revenue to be, I have earned $2,500 more than that estimate. So I hope that with the logic, it's getting clear to you. We are comparing, we're looking at how much sales price should have been and how much it actually was. Should have been 100, actually was 105, so favorable for us. Similarly, if you reverse these figures, 105 was your standard and you actually ended up selling in the market for 100, then you've made an adverse variance of $2,500. Now let's talk about the second variance. This is the sales volume variance. Over here also, the main thing that we are trying to compare, the focus over here is upon the sales volume. How much is the quantity that we should have sold and how much is the quantity that we actually sold. So should have sold is called the budgeted quantity, and how much we have actually sold is nothing but your actual quantity. So again, this is a revenue area. So I will want to maximize the volume. Probably I had thought of selling 1,000 units, but I actually could only sell, let's suppose, 900 units. So my volume variance is going to be, it's going to be adverse over here for sure, because I had thought I would sell 1,000, but I only sold 900. So 900 minus 1,000 multiplied by, let's suppose, my standard margin that I have. So over here, you'll always be taking the margin. So let's suppose the standard margin is 15. So 100 multiplied by 15 is what is going to be my adverse variance. So 1500 adverse is my variance because of the sales volume, because I have not been able to sell what I had thought. I have sold lesser units. Moving on, similar is the logic with other variances also. So let's discuss those as well. Now, if I talk about material price variance over here, it's a cost side item. I want to minimize the price. So over here, I am comparing what should have been the material price and what is the actual that I paid for the material. So let's suppose actually I have paid 9 and the standard was, let's suppose, 10, just for the sake of simplicity. So we had thought that the material would be $10 per unit, and actually we have been able to negotiate and we got it at 9 per unit. So again, like we did it with the sales price, we are going to multiply this with the actual quantity of raw material that we have purchased. So let's suppose the actual quantity that we have purchased is 100 units. So uh, over here, the variance is obviously going to be a favorable one because this is a cost side item. I have managed to bring the cost down. So 10 minus 9 multiplied by 100. So it's going to give me $100 favorable variance over here because I have been able to minimize the cost side of my business. Then talking about the material usage variance. So again, material usage, we are trying to figure out how much quantity we should have used to produce the amount of unit which we have and how much have we actually used. So material usage wants us to find out, have we used, let's suppose, extra, or have we saved in terms of the materials that we use in our production. So over here, the main concern that we have is how much is the standard quantity and how much is the actual that I have used. So let's suppose, according to the standards laid down in my business, one unit should take 5 units of raw material. All right. And the actual, quantity which we have produced is, let's suppose, 10 units, just for the sake of simplicity. So if one unit takes 5, ideally, 10 units should have taken 10 multiplied by 5, which will give you 50. So standard quantity to produce these 10 units will be 50, but I actually ended up using 60. So over here, we know that it is something adverse. I should have used only 50, but I ended up using 60, which is higher. So this is a cost side item. The raw material is a cost. So my cost has gone up. That means I'm going to get an adverse variance over here. And what are you going to multiply this with? You're going to multiply this with the standard price that you have for the material. So let's suppose that the standard price of 1 unit of raw material is, let's suppose, two. $2. So I multiply the difference by 2. So I get a $20 adverse material usage variance, means I have used more material and it has costed me $20 more than it should have. Now let's talk about the labor rate variance. Now, when it comes to labor rate variance, analyze the name again, labor rate. That means how much we are basically looking at, how much the labor should be paid and how much they have actually been paid. So the standard labor rate and the actual labor rate. So let's suppose if the standard labor rate is $25 per hour, we have been able to negotiate that with the laborers and bring down that to 20. So this is basically a comparison. Again, I'm going to get a favorable variance because I have minimized a cost side item. And again, I'm going to multiply this with the actual hours because it's, the saving that we have done over the actual hours. So let's suppose the actual hours worked are 100. So I multiply this with 100. So I get $500 favorable variance, which means I have been able to save $500 because of being able to negotiate a lower labor rate with the labor. Let's also talk about the labor efficiency variance. So over here, lay emphasis on efficiency. We are trying to find out how efficient the labor is. So to find that out, you are going to see that, how many hours should the labor be taking for the production. So the standard hours and the actual hours that they have taken. So we are doing a comparison. So probably let's suppose one unit to produce is supposed to take 5 hours and the actual production is 50 units. So 50, one unit is 5, so 50 units will be 50 multiplied by 5, that's going to give you 250. So the labor should have taken 250 hours, but they have actually taken, let's suppose, 300 hours. So again, I know this is an adverse variance. Why? Because what work should have been done in 250 hours now is, done by my labor in 300 hours. So they are slow, they are not as fast as they should be. So I'm going to get an adverse variance over here. Again, this is going to be multiplied with the standard rate that the labor has, which is 25. So 50 into 25, whatever answer you get over here is going to give you the adverse variance. That means the labor is not efficient. They are taking more time than they should. Another variance which we had in MA was the labor idle time variance. Again, let's break down the name idle time. So we're trying to look at how much, how many hours have they spent doing nothing, have they spent sitting idle. So again, we are trying to see over here that for how many hours have I actually paid, actual hours paid, how many hours have I paid the labor for, and how many hours have they actually worked for. So let's suppose I have paid the labor for 100 hours, but they have only worked for 80 hours. If I try to find out using the time records and everything, I see that they have only worked for 80 hours. That means 20 hours they were sitting idle. So the difference between these two, again, this is going to be an adverse variance because we have paid for more and the work done is less. This is a cost side item. So 100 minus, 80 minus 100 multiplied by the standard labor rate, which is 25. So 20 into 25, $500 adverse variance is what you're going to get as the labor idle time variance. Then the next thing that we talk about is our variable overhead expenditure variance. So as the name suggests, we're trying to have a look at what's the variance in our variable overhead expenditure, how much the variable overhead expenditure should be versus how much it is actually been. So we are basically comparing the standard overhead rate, standard variable overhead absorption rate, and my variable overhead rate and my actual variable overhead rate. So let's suppose I had thought, according to my budgets, that the variable overhead rate will be, let's suppose, $10 per unit, but actually I ended up spending more money on variable overhead expenditure, which led to my actual variable overhead rate to be, let's suppose, $12. So the difference, again, it's going to be an adverse one because I've ended up spending more. So minus 2 multiplied by my actual hours which have been worked. Let's suppose that my actual hours were 100, so $200 worth of money I have spent extra on the variable overhead expenditure. Now let's talk about variable overhead efficiency variance. Now, when I talk about variable overhead efficiency, we are seeing that, how many hours have they actually have, for how much have been the standard hours and how much have been the actual hours. And the difference between the two is something that we multiply with the standard variable overhead rate to find out, how efficiently have we been in spending the variable overheads. So let's suppose the standard hours were to produce the output were 100, and we have managed to produce that work in 80 hours. So the difference is 20 favorable because I have actually taken lesser number of hours. So if let's suppose that my standard variable overhead rate is let's suppose 10, so $200 is something which I have saved because of being efficient. Then let's talk about fixed overhead. So again, the formula, all right, let's discuss this. The fixed overhead expenditure variance. Over here, we are trying to have a look at how much we should have spent on our fixed overheads versus how much have we actually spent. So how much we should have spent will be nothing but budgeted hours multiplied by the standard rate. This is what we should have. And how much we have actually done, so that will be actual hours multiplied by actual rate. So this is the actual. So the comparison between these two is going to give you an answer. If the budgeted is less than the actual, then you have a favorable variance. If actual is more than the budgeted, then you have a adverse variance. So now let's talk about the fixed overhead capacity variance. Fixed overhead capacity variance. So as the name suggests, we're trying to have a look at the capacity of the fixed overheads. So it's going to be nothing but the standard rate which you have, standard rate of overheads, multiplied by the difference of your budgeted hours and your actual hours. Right? This is how you work out your fixed overhead capacity variance. Moving on to fixed overhead efficiency variance. So if I talk about the fixed overhead efficiency variance, it's nothing but how efficient we have been. So it's comparing the standard hours that we should have taken versus how much actually we have taken. It's a repetition of what we have done earlier also. And you multiply the difference between these two with your standard rate. Then the last variance which we have from the carrying of MA is your fixed overhead volume variance. So over here, you are doing nothing but you're totaling up the capacity and the efficiency. So you total this, and then you obtain your volume variance. So I'm just writing 1 plus 2. This is going to give you your volume variance. Now we move on to advanced variances, what we study in PM. The first thing that we learn over here is going to be the factors to consider if at all the variance should be investigated. So there can be when it comes to bigger businesses, there can be multiple variances. So when there are multiple variances, it becomes you cannot, because you have such a big business, it's not really actually feasible or possible to investigate all the variances that arise. So when should a variance actually be investigated is what we are studying. What are the factors to consider if variance should be investigated? First of all is the size of the variance. How big is the variance? Definitely, if it's a big variance, it needs to be investigated. Cost. Again, nothing comes for free. Even if you're investigating why there was such a big variance, there are some costs which you're going to incur. So if the cost itself is bigger than the amount of variance, then there is no point in investigating why that variance has happened. Another factor is favorable or adverse. Definitely, if there is a favorable variance, it works in your favor, then you might not investigate it. But if it is something which is going against you, then you may feel the need to investigate that specific variance. Also talking about the past patterns. So if for let's suppose some item, they have been having a small adverse variance for a long from a long period of time, so that may be a past pattern which follows. So they may not investigate that variance. Then you talk about the budget. Another factor is the reliability of the figures. So probably if it's a very small variance, and there is a probability that due to some rounding of errors, there could have been minor variances. So such variances can also be ignored and not further investigated. Now we move on to the variances which we learn in the performance management exam. The first variance which I'm going to talk about is the material mix variance. Please, very it's very important to focus and emphasize on what exactly the variance is intending to calculate. What exactly do we aim to achieve with calculating this variance? So first of all, material mix variance will always be calculated where there will be more than one material inputs and the materials are interchangeable. Now, what do we mean by that? Let's suppose I manufacture something, and to manufacture this one thing, there are three ingredients, let's suppose, that go into place. There's material A, there's material B, and there's material C. And these materials are interchangeable. That means let's suppose this is 33, 33, 33, 33, or let's take material D also. So if we have four materials, 25, 25, 25, 25. So these are the proportions that they go in, and they together make 100, which is 1 unit. So what happens is that, if, what do we mean by the materials being interchangeable? It means that even if I am, to produce this entire 100, if I am taking, let's suppose, 50 units of A, and then 25 of C, and then 25 of D, that means that still this will be produced. So that is what we mean by the materials being interchangeable, that it's okay if we use one material in place of the other material. Now, naturally, favorable mix variance would mean that higher proportion of cheaper material is being used, and that will help you to reduce the overall average cost per unit. So how do we work this out? First of all, you compare how much is the actual input in your standard mix. Actual input in standard mix. And then you see the actual input in actual mix. And then you see the quantity variance. And then you multiply that by the standard rate per kg, and then you get the cost variance. So this is how the formula goes, but I'm going to explain it to you in a manner that hopefully you do not feel the need to remember the formula. So let's suppose there is a production that we are doing for a commodity, a good, and it's supposed to have 10, 20 and 10. So in total it adds up to 40. So this is the standard cost card, how much the material should be going for 1 unit. And let's suppose we have in total produced, let's suppose, 1 unit itself of 40. And what we have done is we have taken 15 of this, and let's suppose 20 of this, and and 5 of this. So let's also have the standard prices. So the standard prices which should be there for these raw materials per unit, let's suppose is 1 and okay, let's not simplify it this much. 1, 2, and 4, let's suppose. So what happens is over here, if you see, if you find out the variance, first of all, I was supposed to use 10, but I have actually ended up using 15. So I have a negative variance of 5. I should have used 20. I have actually used 20, so no variance. I should have used 10 of C, but I have only used 5 of C, so that means I have saved 5. So if I net this out, I have 0 quantity variance, but when it comes to cost variance, there's going to be some because the prices of these are different. So minus 5 means I have a negative 5 because I've used this by 5 units more. So 1 is the cost, so multiplying by that, and then this is 0. For this unit, material C, 5 is something which I have saved, and the per unit price is 4. So 5 fours are 20. So that means if I overall find out, I have saved $15 worth of cost in one unit of output, and this is going to give me an lower average cost per unit. So that this is what we mean by a favorable mix variance. I have used the most expensive ingredient in a lesser quantity than it should be, and that is why I have a favorable mix variance. Vice versa will be the case that if you overuse the higher the if you overuse the material which is priced higher, then you're going to get an adverse material mix variance. Now let's move on to the next variance. Let's talk about the material yield variance. Now, when I say material yield, we are basically, yield means the output. How much you have, for how much you have input, how much have you been actually been able to achieve is what your yield is. So over here, we are seeing how much material we should have used and how much material we have actually used, and then we find out the variance. So again, this material will be calculated when there are more than one material inputs and the materials are definitely interchangeable. And the adverse material yield variance would suggest that you have used more of inputs to produce less outputs. So you should have used lesser inputs, or you should have produced more with the number of inputs which you have used. So if I talk about a very simple calculation, so let's suppose to produce 100 units, I have actually taken 200 units of 200 kgs of raw material. According to the standards, one unit should take, let's suppose, 10 kg of raw material. So to produce 100 units, it should be taking 10 multiplied by 100, which should be 1000 kgs. Let's make this 1200 instead. Right. So actually, the standard input that is actually allowed should be 1000 kgs because that's the thing according to the standards. But I actually ended up using 1200 kgs. So this is it is very clear that this is going to be an adverse variance. And how much do you multiply this with? You multiply this with your standard cost of input. So let's suppose of all these prices which I have. So if I try to work out a standard cost, so this will be 10, 40, and 4 tens are 40, 80, 90. So 90 comes out to be the total cost per unit, standard cost per unit. So minus 200 multiplied by 90. 18,000 is something which I have as the adverse yield variance. That means I've overused the raw materials, and because of overusing raw materials, I have spent $18,000 more on the raw materials. Now I move on to what can these variances impact. So your material mix and yield variances can impact, first of all, the cost, definitely. Then it can also impact your quality. Just to get a favorable material mix, maybe you're using more of the cheaper material and lesser of the expensive material. Then in that case, the quality of your product is also going to get affected. So that's how quality comes into the picture. And then you talk about the performance measurement. Definitely you are if management, you're evaluating the performance of the management also with the help of these variances. So let's also see what are some of the performance measures for controlling production related variances. So if I talk about this, what all can be done? So there can be quality measures. Definitely this will help with the material mix. So if they are not meeting the quality, they will be rejected. Then there can be average cost of input. Then another measure which you can use is the average cost of output. Another thing which you can use is the average prices that you have achieved for the finished goods. Then another measure can be the average margins. How much are you actually, so let's suppose selling price minus variable costs, how much are your margins? And then another measure can be percentage of on time deliveries. How many orders have you been able to deliver on time? Deliveries. Another performance measure can be the customer ratings. How satisfied are these customers? Satisfaction ratings. Another thing can be the percentage of idle time. So these are just a few examples of what performance measures can be used to control production processes. Now we move on to sales mix and quantity variances. So when it comes about sales mix and sales quantity, again, these both variances will only be calculated when you are selling more than one product and the products are also interchangeable. So let's suppose I am selling product A and selling product B. Selling price of product A is 150 and selling price of product B is, let's suppose, $300. So these are the two products that I sell and these are interchangeable. Let's suppose I have budgeted to sell 200 units of product A and 100 units of product B. And let's suppose, this is what my budget is. And let's suppose the actuals have been 500 units of this. So in total, let's make it 300 and let's make this also 300 just so that we are able to draw a better comparison. So let's suppose 100 of this and 200 of this. So basically sales mix also aims to analyze how much is the difference between the actual mix. This is the actual mix and how much is the difference between the budgeted mix. So we are valuing this as at the standard profit. So let this be the standard contribution per unit. So let's try to find out. First of all, for product A, we were supposed to sell 200, but we actually only sold 100. So we have a negative 100 variance and you multiply this with 150. For product B, we were supposed to sell 100, but we actually ended up selling more, which is 200. So 100 positive multiplied by 300. So negative 150 is something which is my adverse variance because selling less of A and selling more of B gave me 15,000. Yeah, and this is going to be 30,000. So these are the variances which I get per product. So in total, I have earned 15,000 more. And why is that? Because I have actually been able to sell more of the product, which is giving me more contribution. That is why I have a positive variance. Had this case been reversed, if I had sold more of the product A, then I would have an adverse variance. Then let's talk about the sales quantity variance. So the main thing that we are concerned with over here is about, how much quantity we were supposed to sell and how much we have actually sold, and you multiply that with the profit or contribution per unit. So you compare the actual sales in standard mix, and then you compare this with the standard sales in standard mix, and then you find out the unit variance. You multiply this with the contribution, standard contribution, and then you get the profit or contribution variance. So this is how you work out this one. And if you even want to learn the individual method, you can find this out using the actual total sales. So let's suppose the actual total sales is 300, continuing with the above example, and the budgeted difference, budgeted is also 300, and you multiply over here, we get a 0, but hypothetically, if you have a value over here, you multiply that with the standard weighted average contribution per unit. So with this, you will get your answer. Now, the next thing that we talk about is going to be about the planning and operational variances. So, if I talk about planning and operational variances, basically this is the division of the variances between their two components. The variances are already consisting of these variances. We are just splitting these components to find out where exactly the fault is the fault there in planning or is the fault there in operations. So first of all, we had learned the material price variance. So let's talk about that. Material price variance. So, basically we are just finding out that out of the total material price variance that we have, how much of this variance is because of the planning department and how much of this is because of the operations managers and the people who are actually working, carrying out the operations. So basically, if I talk about the planning variance, the planning guys were supposed to set the budget or the standard. So they set a standard price. But what actually should have been the price according to the revisions in the standards, which they did not do, so that should have been the revised price. So the difference between these two is what is going to tell their fault, and you multiply this difference with the quantity, which is the actual quantity. So with this, you will be able to find out by how much were the estimates of the planning department off. And then you talk about the operational variance. So in the operational, you're going to compare the actual performance of the purchasing manager. The raw material is usually purchased by the purchasing manager. How much has he been actually able to purchase it for and how much he should have purchased. So this is the revised price. So his performance is not going to be compared with the standards. His performance is going to be compared with the revised because that is what the standard originally should have been, keeping into account the changes which the budgeting people did not notice. And this again will be multiplied with your actual quantity. So similarly, this is going to repeat for all of the variances which we have learnt. If we talk about the material usage variance, so again, here usage is the main issue. So planning people would have thought about an original quantity allowed, standard quantity allowed, how much material should they be allowed to use versus how much should have been the revised quantity allowed. So the difference multiplied by the original standard price. Similarly, the operational is going to compare the revised and the actual, and similarly multiplied with the original standard price per kg or per unit of the raw material. So this is how they are going to go for the rest of the variances also. The main issue over here is splitting these variances into the faults of different people. So if the planning people have done, failed at getting a realistic cost, then they should be held responsible and not the operations people if at all there's an adverse variance. And if there's an adverse variance when it comes to the comparison between the revised and the actuals, then the operational people should be held responsible. Now let's also talk about the fact that, if it comes up in section C, how are you going to draft the theoretical parts? Drafting theory. So what you're going to do is, first of all, you do the calculation, you calculate the variance. Along with the calculation, do not forget to mention whether it's adverse or favorable. Then the second thing that you will do is give the reason for being favorable or adverse. Third thing which you're going to do is the interdependence. How are these variances, whatever variances that you calculate, are they interrelated with each other? Probably because of a poor performance by one, there was a poor performance by the other, or whatever the interdependence between these variances is, and then you're going to give a conclusion. So this is how you're going to draft your theory. If your theoretical answer has all of these four elements, then nothing can stop you from getting good marks. Now let's also discuss, when should a budget be revised? When should a budget be revised? Budget is, also prepared by a human. It will not always be perfect. So what are the situations under which we should revise a budget? So first of all, it should be revised when there is a change in one of the main materials that is used to make the product or provide the service. Change in one of the main materials. Another thing is when there is an unexpected increase in the prices of materials due to rapid increase in world market prices. So unexpected increase in prices of raw materials. Then third thing when you should be revising the budget is when there is a change in working methods and procedures that alters the expected direct labor time for a product or service. So basically a change in labor time, direct labor time. Then next thing is when there is an unexpected change in the rate of pay to the workforce. Unexpected change in the rate of pay to the workforce. Then the next topic that we are learning is when variance analysis will not be appropriate. So the suitability, basically in what scenarios will it not be suitable, right? So it will not be suitable when there are non-standard products. That means the products keep changing according to the needs of the customers. They are not standard. So that is when variance analysis should not be used. Then another area is where standard costs become outdated quickly. Where the industry is such that the standard costs change quickly, over there also you should not be using the variance analysis. Then thirdly, it is not suitable where there is a highly automated production. Another circumstance is the use of ideal standards. So you should always be using the attainable standards and not the ideal standards. If you want to use ideal standards, do not use the variance analysis. Another thing is when there is an emphasis on continuous improvement, because variance analysis involves setting standards. So once you set standards, they're there for a for the people to follow them. But if you want people to continuously improve, do not give them such standards. Then another scenario is when detailed information is required. Another circumstance is where monitoring performance is important. The last thing that we are going to learn in this chapter is, talking about participation in standard settings. So do you involve the employees in setting the standards? Do you take their participation? So of course there will be advantages and there will be disadvantages. First of all, talking about the advantages, definitely they are going to have motivation and there's going to be a higher morale of the employees. Then second advantage is that there will be more acceptance because they are the people who have set those standards, so they will accept them. Then thirdly, there will be clarity of work, again because they have been involved, they will know what exactly is required, is expected out of them, so there will be a clarity of work. Now if I talk about the disadvantages, first of all, there will be reluctance from the senior managers. Definitely, when you're trying to make one person happy, the other gets unhappy. So, reluctance from senior management. Then it will be time consuming to take, inputs from so many people, so many employees. Then thirdly, there can be slack targets. What do we mean by this is that if employees are themselves setting targets for them, they may set too easy targets so that they are easily able to achieve the targets and get the rewards. So with this, we have been able to finish the revision of the chapter on advanced variances. I hope that this way, with this you have been able to recollect all the concepts which you have learned in your preparation for the PM exam. We will meet in the next video with chapter number 13. Thank you so much for watching.